Financial markets need clear, comprehensive, high-quality information on the impacts of climate change. This includes the risks and opportunities presented by rising temperatures, climate-related policy, and emerging technologies in our changing world. TCFD, Task Force on Climate Financial Disclosures, is one such disclosure framework which is crucial in building a more sustainable and resilient economy and a safer future. Hi, my name is Dr. Shruti Sharma, and today I'm going to simplify TCFD, Task Force on Climate-Related Financial Disclosures to you. The Financial Stability Board (FSB) created the Task Force on Climate-Related Financial Disclosures (TCFD) in 2015 to improve and increase reporting of climate-related financial information. The TCFD's focus is reporting on the impact an organization has on the global climate. It seeks to make firms' climate-related disclosures more consistent and therefore more comparable. As both companies and investors increase their understanding of financial implications of climate change, markets will be better able to channel investment to sustainable and resilient solutions, opportunities, and business models. Now, TCFD has developed a reporting framework based on a set of consistent disclosure recommendations for use by companies as a means of providing transparency about the climate-related risk exposures to investors, lenders, and insurance underwriters. Improving the quality, consistency, and transparency of climate-related financial disclosures will allow economies to have the necessary information to better assess the impact and effects of an organization on climate change. An important element of such framework is the consistent categorization of climate-related risks and opportunities. Now, as a result, the task force TCFDs define categories for climate-related risk and climate-related opportunities. The task force recommendations serve to encourage organizations to evaluate and disclose as a part of the annual financial filing, preparation, and reporting processes. The climate-related risks and opportunities that are most pertinent to the business activity. TCFD categorizes following climate-related risk and opportunity that organizations should consider as a step 1. The task force divides climate-related risk into two major categories: transition risks and the physical risks. Now, first, the risk related to the transition to a lower carbon economy, and the second, physical risk, which is risk related to the physical impact of climate change. Let's look at the first kind of risk, which is transition risk. Now, transitioning to a lower carbon economy may entail extensive following risks: policy, legal, technology, and reputational risks. Depending on the nature, speed, and focus of these changes, transition risk may pose varying level of financial and reputational risk to the organization. Now, when you look at policy and legal risks, policy actions around climate change continue to evolve. Their objective generally falls into two categories: policy actions that attempt to constrain action that contribute to adverse effect of climate change, or policy actions that seek to promote adaptation to climate change. Now, some examples include implementing carbon pricing mechanism to reduce GHG emissions, shifting energy use towards lower emission sources, adopting energy efficiency solutions, encouraging greater water efficiency measures, and promoting more sustainable land use practices. The risk associated with and financial impact of policy changes depend on the nature and timing of the policy change. Now, another important risk in transition risks is the legal risk. Recent years have seen an increase in climate-related litigation claims being brought before the courts by property owners, municipalities, states, insurers, shareholders, and public interest organizations. Now, the second kind of risk in transition risk is technology risk. Technological improvements or innovation that support the transition to a lower carbon, energy efficient economic system can have a significant impact on our organization. Now, for example, the development and use of emerging technologies such as renewable energy, battery storage, energy efficiency, and carbon capture and storage will affect the competitiveness of certain organizations, their production, and the distribution costs, and ultimately the demand of their products and services from end users. To the extent that new technologies displaces old systems and disrupts some parts of existing economic systems, winners and losers which will emerge from this creative destruction process. Now, the timing of technology development and deployment, however, is a key uncertainty in assessing technology risk. The third kind of risk in transition risk is the market risk. While the ways in which markets could be affected by climate change are varied and complex, one of the major ways is through shifts in supply and demand of certain commodities, products, and services, as climate related risks and opportunities are increasingly taken into account. Now, again, reputational risk is also one of the most important transition risks. Climate change has been identified as a potential source of reputational risk tied to changing customer or community perceptions of an organization's contribution to or detraction from the transition to a lower carbon economy. Now, let's look at the physical risks. Now, physical risks resulting from climate change can be event driven, which is acute, or long term shifts, which is chronic in climate patterns. Now, physical risks may have financial implications for organizations, such as direct damage to assets and indirect impact from the supply chain disruption. Organizations' financial performance may also be affected by changes in water availability, sourcing, and quality, food security, and extreme temperature changes affecting organizations' premises, operations, supply chain, transport needs, and employee safety. Now, TCFD, along with analyzing risks, which is physical risks and transition risks to the business, also helps in mapping climate related opportunities. Climate related opportunities will vary depending on the region, market, and industry in which an organizations operate. The task force identified several areas of opportunities. The few of them are the first one let's take is resource efficiency. There is growing evidence in examples of organizations that have successfully reduced operating costs by improving efficiency across the production and distribution processes, buildings, machineries, appliances, and transport, mobility in particular in relation to energy efficiency, but also including broader materials, water, and waste management. Now, the second opportunity is energy source. Now, according to the International Energy Agency, IEA, to meet global emission reduction goals, countries will need to transition a major percentage of their energy generation to low emission alternatives such as wind, solar, wave, tidal, hydro, geothermal, nuclear, biofuels, and carbon capture and storage. Organizations that shift their energy usage towards low emission energy sources could potentially save on annual energy cost. The third opportunity in TCFD is related to products and services. Organizations that innovate and develop new low emission products and services may improve their competitive position and capitalize on shifting consumer and producer preferences. Now, resilience is the last opportunity according to TCFD. Resilience is also an opportunity. The concept of climate resilience involves organizations developing adaptive capacity to respond to climate change to better manage the associated risks and seize opportunities, including the ability to respond to transition risk and physical risk. Opportunities include improving efficiency, designing new production processes, and developing new products. Now, apart from identifying climate related risks and mapping opportunity, TCFD focuses on the financial impacts. Now, better disclosures of the financial impact of climate-related risks and opportunities on an organization is a key goal of the task force work. In order to make more informed financial decisions, investors, leaders, and insurance underwriters need to understand how climate related risks and opportunities are likely to impact an organization's future financial performance as reflected in its income statement, cash flow statement, and balance sheet. TCFD gives 11 disclosures recommendation span in 4 different areas. The 4 areas are governance, strategy, risk management, and metrics and targets. The 11 recommendations are summarized as follows. Now, under governance, the companies must describe the board oversight of climate related risks and opportunities. They should describe management role in assessing and managing climate related risk and opportunity. In the second area, which is strategy, the organizations must describe the climate related risk and opportunity the organization has identified over the short, medium, and long term. They should describe the impact of climate related risk and opportunities on the organization's businesses, strategy, and financial planning. The organization should describe the resilience of the organization's strategy, taking into consideration different climate related scenarios, including a 2 degree centigrade or lower scenario. In risk management, they should describe the organization process for identifying and assessing climate related risks. Now, organizations should describe the organization's processes for managing climate related risks. They should also describe how processes for identifying, assessing, and managing climate related risks are integrated into organizations' overall risk management process. Now, the fourth area, which is metrics and targets in TCFD. Now, in this, the organization should disclose the metrics used by the organization to assess climate related risks and opportunities in line with its strategy and risk management processes. Organizations should disclose Scope 1, Scope 2, and if appropriate, Scope 3 greenhouse gas emissions and the related risk. They should describe the targets used by organization to manage climate related risk and opportunity and performance against the target. Now, the TCFDs are important for businesses to improve their own understanding of their long-term climate-related risks and opportunities. The disclosure of organizations' forward-looking assessment of climate-related issues is important for investors and other stakeholders in understanding how vulnerable individual organizations are to transition and physical risk and how such vulnerability or would be addressed. As a result, the task force believes that the organization should use scenario analysis to assess potential business, strategic, and financial implications of climate related risks and opportunities and disclose those as appropriate in their annual financial filings. Scenario analysis is a process for identifying and assessing the potential implication of a range of plausible future states under condition of uncertainty. Scenarios are hypothetical construct and not designed to deliver precise outcomes or forecast. Instead, scenarios provide a way for organizations to consider how the future might look if certain trends continue or certain conditions are met. In the case of climate change, for example, scenarios allow an organization to explore and develop an understanding of how various combinations of climate related risks, both transition and physical risk, may affect its business strategies and financial performance over time. Climate scenario analysis can be qualitative, relying on descriptive written narratives, or quantitative, relying on numerical data and models, or a combination of both. The task force recognizes that incorporating scenario analysis into strategic planning process will improve over time as organizations learn by doing. To facilitate progress in this area, the task force encourages further work as further developing 2 degrees centigrade or lower transition scenarios that can be applied to specific industries and geographies, along with the supporting output tools and user interfaces by broadly developing accepted methodologies, data sets, and tools for scenario based evaluation of physical risk by organizations. By making these data sets and tools publicly available to facilitate use by organizations, reduce organizations' transaction cost, minimize gaps between jurisdictions in terms of technical expertise, enhance comparability of climate related risk assessment by organizations, and help ensure comparability for investors and creating more industry specific, which is financial and non financial guidance for preparers and users of climate related scenarios. Now, from this year, that is 2024 onwards, the ISSB will take up control of TCFD progress. ISSB Chair Emmanuel Faber said, the TCFD has been a trailblazer in raising the practice and quality of climate related disclosures, providing much needed information to investors about climate related risks and opportunities. IFRS S1 and S1 are climate focused, but the former also covers other related environmental risks and opportunities. IFRS S1 has been described as the core baseline of sustainability reporting. It has been designed to be applicable to all large businesses, regardless of sector or geographical location. It covers company impact, including emissions across all scopes and waste management. It sets out how to report these factors alongside financial information. IFRS S2, meanwhile, is more detailed in regard to specific topics, particularly climate-related mitigation and climate adaptation. It is designed to build on existing disclosures framework in this field, chiefly the TCFD. The standard also outlines how businesses can assess how future climate-related risks and opportunity could impact their valuation. We can say that TCFD is a clear front-runner in climate-related disclosures and is here to stay. Thank you.